Okay, so we're going to get started in just about 60 seconds. It's Friday, August the 21st. See behind me the Hawaiian state flag. Today is Hawaiian Statehood Day, celebrating the Hawaii becoming our 50th state. That happened in 1969. Hawaiian Statehood Day takes place on the third Friday of August every year. That was something started in 1969. They made that official. So you don't see it advertised much. I'll talk about Hawaii in just a minute. And they have some special issues going on during the pandemic, which makes them unique and really challenging for their economy, not only now, but going pretty far into the future, apparently. And we'll talk about that. We have a lot to talk about. We've had a busy week. It doesn't seem like it, but a lot of things went on, and we'll get into that in just a second. We got some great weather. Looking forward to that. We're kind of having an August weekend. It's going to be a little hot, which I'm not a real big fan of, but fall is right around the corner. That's pretty exciting. And we'll be ready to go. Schools in Paola started this week. And Osawatomie started in the past week. And then Johnson County, it starts September the 8th. And they've decided to go all online until at least September 22nd. So we'll get started. It is Hawaiian Statehood Day, which is pretty exciting, I think. I've been fortunate, been able to travel Hawaii quite a lot. So mahalo to everybody joining us this morning. I appreciate you being here. I got a couple things to talk about. First off, we had a chance to look over the FOMC notes from their last meeting, and they released a statement immediately after that. And then a couple of days later, we're able to look over all their comments. There was not too many surprises in those comments. They're saying that they're looking at a pretty weak end of 2020 into 2021, and they're starting to indicate 2022 first quarter may be come before they see any increase of what's going on. They're talking about their rates being right where they are, which is 0 to 0.5%. They've indicated that they plan on continuing buying treasuries and collateralized mortgage obligations to try and shore up the market, and that will continue. The interesting thing about all of this is, for decades, we've always said that the market kind of precedes what's going on by about 3 months. And in their statement, they actually say that as COVID goes, so will the economy. But if you're looking at the stock market, you're not really seeing that. And so that's kind of an interesting take on this. The NASDAQ and the S&P 500 both hit 52-week highs this week. And I'll show you that in the chart in a second. And the Dow's getting really close to where we started the year at. So it's not necessarily true right now, but our concern obviously is going forward. What do we see happening? We saw Target had awesome returns. They were up 20% this week, which is incredible. And then as we track the top 10 and the bottom 10 performers every week, which we do, and again, this is not a venue to recommend buy or sell securities, but we see that the top 10 and the bottom 10 are really spread out across all the sectors. One of the most common questions I get is, what sector should I be in? Well, right now, the best thing to do is be in all the sectors, because we see some financials did it for the top 10. We have a couple financials in the bottom 10. We have some industrials in the top 10. We have some industrials in the bottom 10, and it goes on and on. So across the board, there's just a lot of movement. We do have the school starting again. That's important. We'll see how that goes. We've talked for a long time about bricks that kind of fall into place that we watched for here. One of the bricks that fell into place last night, which we expected, but we now have an official Democratic Party slate for November election. That's good. That's something we know. So the market really likes to have things in place. The next real key thing is September 15th, when the FOMC releases their predictor for the economy going forward. That's going to be an important date. Next week, we have the official Republican ticket nominee, and that's kind of a given. We know where that's going to go. And then, of course, the election. And now the floating target is COVID, the cases, people going back to school, seeing how that affects it. One of the other guys and I were talking this week, it's not just restaurant entertainment that's gotten hit. You see a lot of small pockets of small companies that have gotten hit, small companies that can no longer sustain their business. And we talked about Hawaii. I mentioned Hawaii. They're just getting annihilated. Right now, if you fly to Hawaii, you have a 14-day quarantine. They're trying to create a system where if you fly into the state, you can stay on a resort for 14 days, but you can't go out. But they have had some very long lasting, very famous hotels, restaurants closed. Chart House has been there for years. There's a sushi place on Kauai that's been there for decades, and they've shut down. So you've seen a lot of that, and people just walking away. And those are concerns, and you kind of wonder how Hawaii is going to survive some of this. There's some good and bad going on this week, and let's take a look at the charts. Mallory, if we would, let's start with the Dow Jones COVID chart. And everybody knows I'm kind of a trendist. I look and see how the trends are going. And if you come over here, far right-hand side, you're going to see that the blue is that's the daily movement. And then the yellow or the orange is the 7-day average. And then the gray is the 14-day average. And you're going to see about 2 weeks ago, these started picking up, and that's great. We talked when it started that we had an opportunity for a V recovery or a W recovery or a Nike swoosh. And they're officially now calling this a V recovery. I would call it a lazy V, but you can see that we're very close to being back where we started on January the 1st. And not only the Dow Jones average, but as I said a second ago, NASDAQ and S&P are actually above where they were January 1st. Not by a lot, but they have recovered from this deep trough that took place on March 23rd. So this actually is not an abnormal chart at all when you look at recoveries over the last 120 years. Very common to see a steep decline and then about a half of that as a recovery. And that's pretty much exactly what we're seeing here. So no big surprises, nothing unusual. The unusual part was what caused this. And now it's a matter of how long does this recession really last? And we'll have to wait another probably 60 days to figure that out. So Mallory, the next chart, please. There we go. This is the market performance this week. Dow Jones is down 0.6%, about 0.7%. NASDAQ is actually up 2.25%. Remember, that's a tech-heavy index. And the S&P 500 is up 0.4%. I really like that because if you take that times 52 weeks, you've got a really solid annual return. So this is a good number, and I like to see that. The other two, NASDAQ only alarms me because it is very high in technology. There is more risk. There are less dividends tied to that. So it's not unusual to see it be a little bit more volatile. But that S&P 500 number, that's just really, really positive to me. So I like to see that. But either way, this tells us we had a nice stable week going on. And then we'll see how today goes. And today looks to be, the futures as of an hour ago, were pretty quiet. So I'm not expecting a whole lot today. I don't think that the Democrat slate getting approved last night and becoming formal is going to make a big change in the market. We'll see how it goes. Next chart, Mallory, please. And this is our housing starts. Now, this was a really bright spot in the economy this week. It was almost the biggest surprise that I've seen in a long time. It certainly was the largest spike in housing starts that we've seen in probably 50 years. Down at the bottom of that, you see a red bar. I've put that in to show you the COVID period, and you can see how housing starts, which is the blue line, took a serious decline as soon as the COVID issue started. Housing starts, they stopped. Nobody was building houses. And typically, you'll recall what I've said in the past, is you see a spike in April and October in housing permits. That's very normal. Historically, that's quite standard. In April, they're ready to get under roof. They're ready to start building. In October, they're trying to get the roof up to get the houses what's called under roof so they can work on the interior during the winter months. It takes them about typically 90 days to get a house up. So to see a spike in April and October is very normal. To see this spike was incredible, 22% in 1 month. And you'll see that that orange line, here you see the blue arrow. That blue arrow indicates 1.2 million starts, and that's the number we really want to see. And that indicates I don't want to use the word robust, but that indicates a solid housing market. Anything above 1.2 is nice to see. It's a comfortable number. That floats through financials, that floats through industrials, that floats through goods, that floats through services. That floats through a whole lot of other sectors when you have a good, solid 1.2 million housing starts a year. And here we are, all of a sudden, we're back above that. And that's really great to see that. And you see the gray line is the moving average, that's picking up. But that 22% increase month for the month was just really wonderful to see. Now we'll come out in about 2 weeks. We'll get the next month's numbers and we'll see how that looks. But this is a very positive sign. It goes along with what we're seeing in the economy in general as far as the stock market's concerned. And it kind of supports what we're seeing in the next chart, Mallory, which is the unemployment. So you can see we had a little bitty rise in unemployment. And remember what happens on unemployment is they publish their numbers and then for about the next 3 weeks afterwards, they make adjustments. And so my chart here is always going back and making adjustments going back about sometimes 4 weeks. And you can see the blue line is the weekly filing and then the red line's the moving average. And we're seeing that dwindle back down. Now, some of that I expected to go down again this week because of the unemployment benefit. We're going to see more people going back to work, we hope. And I do an informal survey on Saturday and Sunday where I'm driving around looking for places that are hiring. And there are a lot of service companies looking to hire right now. I'm seeing a lot of jobs trying to be filled. That's good. And definitely they're not, high earning jobs, but they're definitely supporting blue collar end and income 50,000 and below. And that's kind of the backbone of what we are. We're small business oriented in this country. So it's good to see that number sliding down a little bit. And we'll see what happens next Thursday's report and see where we are. But that's a trend that just really, really looks positive. And then Mallory, if we can go to one more chart, please. And this is the Treasury. You can recall what we see back here where these two lines merged. And we had just a very small period of time where we had an inverted yield curve. And to refresh everything, an inverted yield curve is when the 10-year Treasury is returning less than the 2-year Treasury. And ideally what we want is we want someone to be rewarded for a longer investment. So we typically want to see the 2-year Treasury paying something and the 10-year Treasury paying something plus. And when they invert, that's usually not a good sign. And historically, an inverted yield curve, which happened back in earlier in the year, is an indicator of a coming recession. And sure enough, that's pretty much exactly what happened. So now, while here on the far right-hand side, you can see that spread, which is very nice to see, where you can see a 2-year return on your investment for a 2-year Treasury. And then the 10-year, there's a nice wide gap there, which is what we want to see. Now, we're still concerned that that number is very, very low. It's not great, but you're still getting a premium for a long-term investment, and that's good. Now, if we could see those start to slide upwards, but as a warning, we're not going to see that anytime soon. The FOMC notes are telling us that. They're telling us that these little bitty rates down here at the 2-year number are going to be here for probably 18 more months. But as long as we can see that spread, we're comfortable with that. Then if we could see them grow together, that would even be a better sign going forward for the economy. So those are some key things from this week that we've been watching that are really important. There was a lot of good news. We don't want to overreact. We have a big cautionary tale about going into the school year. We have a cautionary tale about companies that may not be able to survive another shutdown. The president of the Minneapolis Federal Reserve, he's recommended that we shut down for another 2 weeks. So far, he's alone in that recommendation and probably will be. I see a lot of resistance for that between now and the election. It's going to be interesting to see what happens now between now and the election as things go, and that's going to be something we keep our eye on. We'll start preparing for that. We do think there's still a chance for another decline in the market in October, November. And obviously we're cautious about that. We think it's a cautionary tale and we're being mindful of that. So that's kind of where we're headed. It's always in the back of our mind. Could it happen again? Remember what Ben Bernanke said, that we could see a W recovery, and we're still kind of susceptible to that happening. So those are the things we're seeing this week. A lot of good news, some cautionary news. The market is not, my only comment personally is I don't see the market really performing as COVID is performing right now. Our deaths are about 160,000 in the United States alone. The market seems to be ignoring that. And that makes me a little bit cautious because historically the market has reflected what's going on. So, but the other part, what I said earlier, the market typically is about 3 months ahead. So maybe that's a good sign. So everything's very cautious. That ends our time this week. The next couple of weeks we're going to be here every Friday. This is really great. I want to say mahalo for joining us. If you have any friends that you think, turn them on to this. Our objective here is deliver information with no politics, no commercial interruptions, and try and do it in a manner that's nice and understandable, not any super secret code words that we use in the investment, financial, and trust business. And I hope everybody has a good week. Stay comfortable, enjoy your family, and aloha from Paola. Thanks for joining us.